Good evening. This is Duane Lowry for the DPP Grain Desk on Sunday, June 30th. It's about 6:45. The markets tonight are going to be called lower. To what degree remains to be seen, but we'll start with an easier bias. I think it's possible we'll see some recovery attempts here as the week unfolds. A couple of things that I want to talk about before we get into the market outlook here. The 4th of July is coming up this Thursday, and Farms Technology and the DPP Grain Desk wants to help you capture holiday moments and memories in style. We're going to be holding a drawing for a GoPro Silver Edition camera. Everyone who registers for the free DPP mobile app starting now until next Sunday, July 7th at noon, will be entered into this drawing. Don't forget, producers can now register too, and I will reveal the name of the winner in next Sunday's grain video. Android users need to search DPP in their Play Store, and Apple users should search DPP in their App Store for both the iPhone and the iPad apps. As far as the markets are concerned, focus is still about Friday's report. I think it's important that we step back and look at the Friday report and view it from the perspective of how the market was leaning going into that report. The trade's been bearish for quite some time, and the marketplace has known and expected and fully respected the ultimate possibility of having a much more abundant supply outlook this fall than we have had for the last year or more. And I think that has kept a bearish attitude. The last 7 days, with Friday's price action closing lower, that was the 7th consecutive day that corn had closed lower. And I think that now you've got Dees corn down here at 510, which is the bottom side of the parameters we've seen for some time. Sat down 7 days in a row, a setup where the trade was already bearish going into the report. They got a bearish report, but yet nothing super shocking. The trade is using yield and acreage mixes that come out with anywhere from a 1.8 to 2.2 billion carryout scenario for the next marketing year, and it's difficult to find anybody under 1.8. And so all of that's bearish, and none of that is really a big shock from what the marketplace seen as a possibility back to December, January, or February. But it is also true that we are now farther along that growing season and closer to that eventual reality. There's still a situation. We have a lot of acres in the western Midwest that suffered from excessive moisture. My experience says it's difficult to fully recover from those excessive moisture problems, and there's something that linger on, and too often you find disappointment by the time you get to fall. You can't fully recover those losses. You end up losing nutrients, and often it's difficult to get those fully reapplied. We've also got the late planting date, the very slow crop development, so we do have issues here. The other thing to keep in mind, usually the marketplace doesn't completely and fully embrace the bearish scenario in these type of scenarios until we reach the point of being 50% pollinated. Those pollination dates of 50% on a national level is probably at least 3 weeks away, quite possibly longer than that. So we only can forecast weather out for 2 weeks, so we still have a period of time where the marketplace could possibly get nervous. At the present time, the current weather forecast has significantly drier weather for these wetter areas of the Midwest over the next several days. That's certainly going to be beneficial. We need that, but we also need some heat. We've got too many acres that are still far behind development, and still much cooler temperatures over the next several days than what we'd like to see. There is some hint of improving temperature patterns starting next week and beyond. So I think that a producer that's wondering about where do I make the next sale, where do I add to my hedges, you're trading at 510 Dees now. This does not look like a very attractive place to make sales, but on recoveries back to 530 to 550, 20 to 40 cent recovery from where we got to on Friday, that may be about all we can expect to get in some sort of normal corrective pattern without experiencing a very notable production threat that unleashes a more significant short covering rally. That certainly is a possibility, but we don't see anything on the horizon right now that would suggest that's going to happen. Trader sentiment is very bearish, may very well be too bearish, but at the present time they're going to get to drink the Kool-Aid from having a bearish USDA report on Friday. How long this bearishness spills over into this week, it remains to be seen. It certainly can, but I think there are reasons to be cautious about embracing that weakness at this time. You still have old crop corn, which closed significantly higher in the July futures on Friday. That market is going to be well supported. There's no sign that the cash market's just going to roll over and tumble here. Supplies are very tight. The July futures market could have an upside explosion. If that happens, to add on 20 or 30 cents more in that type of environment would be nothing. To add 50 to 75 cents from Friday's close in July futures is not an unreasonable, it might sound outlandish, but it's not an unreasonable statement in this business for that type of thing to happen before expiration. So I think that you have to look at new sales in corn here from the perspective of down 7 days in a row already. The market's already anticipated this bearishness, and now we get it. You have the old crop corn that might give us an upside explosion here over the next 2 weeks trade in the July futures market. The trade will have to react to that, and I think that could make bears a little bit nervous and cautious, and I think there's potential for some better selling opportunities to unfold over the next 3 to 4 weeks. But in the long run analysis, it's always been the case that downside potential could be very significant, as in 450 futures, maybe less, who knows. I'd say that possibility still exists, but this business is always about timing, not ultimate realities, and I think from a timing perspective, I hope there are better selling opportunities than having to make sales on the 8th day in a row that you've been down here. As far as wheat is concerned, there was nothing significantly new in Friday's reports. I think that wheat was a follower to corn. The global wheat pricing structure is such that U.S. wheat futures look too high, but that has been the case for quite some time, and I'm not sure that the wheat market is just going to tip over and suddenly go to a race to the bottom based on global wheat values. I don't think that's going to happen here, but I can understand why somebody would have that view. As far as recovery potential in wheat, if we could get a recovery in corn, where you could get corn to rally 20 or 30 cents off of the post-report lows here, that could easily translate into a 30 to 50 cent recovery in wheat. Such a rally in wheat has got to be seen as an attractive selling opportunity for hedgers, producers. Right or wrong, whether we like it or not, it's very possible that the fundamental outlook is changing significantly from what we've experienced the last few years, and we've got a global speculator investor that is not that interested in owning commodities, and you've got a lot of things here that point to trouble ahead and much lower prices. So somewhere here, you need to add to price protection strategies that you might have put on back in January, February, and March. Somewhere along here the line, you've got to find a place here to put on additional price protection to join forces with the protection that you're going to have from your crop insurance. But I'm hopeful that we don't have to make those type of sales tonight, but I think you're going to have to ratchet down your selling targets. If you had $5.70 to $6 December futures before, now you probably got to lower it down to $5.35 to $5.50, something like that, until or unless something develops in terms of a production threat different than what we have now. As far as beans are concerned, I don't think the speculator is looking to aggressively sell beans here. I don't think beans will be the favorite way for them to express bearishness. Right or wrong, they're looking pretty heavily to keep focused their bearishness, mostly focused on corn. The beans, there's going to be a lot of people that aren't going to believe Friday's USDA acreage number on beans. They're going to believe that the final acreage number is going to be less. When you look at what USDA has plugged into their June S&D report in terms of a average national yield on beans, that's a pretty optimistic yield considering we're off to what I would say not as a very good start, number one, because we haven't had timely planning. So I think that it doesn't take much of an imagination to get your soybean carryout next year projection down to around 200 million bushels, and that's significantly lower than where people thought beans would be over the last 60 or 90 days as a possibility. So I think that there'll be some caution and pressure in the short side of beans here, but we still need some sort of a production threat to trigger some short covering to give us a chance to get beans back up to pre-report levels. I think it's a possibility. I don't think it should be ruled out at all, but I do believe that producers need to be looking at things from a long-term perspective and recognize downside risks still exist from these levels. It's just a question of whether the timing to make those next sales needs to be made on weakness tonight. I hope that's not the case. I hope we have some better selling opportunities ahead over the next 3 weeks. So for the DPP Grain Desk, this has been Duane Lowry. Make sure that you sign up for the free GoPro Silver Edition camera. We'll make that announcement on that drawing on Sunday night during the grain video. So for the Farms Technology and the DPP Grain Desk, this has been Duane Lowry.